Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing TotalEnergies stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. TotalEnergies is one of the 7 super major oil companies. Its businesses cover the entire oil and gas chain, from crude oil and natural gas exploration and production to power generation, transportation, refining, and marketing. The company is headquartered in Paris, France, and was founded in 1924. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Xetra, Vienna, Swiss, Buenos Aires, Bulgaria, Euronext Paris, and Italian Bourse. Let's get started with the model. This is a large cap company, 129 billion market cap. They're trading at $50 a share, and they have 2.6 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is huge in 2021, over $18 billion. It was only $4 billion in 2020. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that also peaks in 2021 at $16 billion. Their revenue is flat from 2018, but it grew a lot from 2020. The reason it's so low in 2020 is because the price of oil was a lot lower when compared to other years. The price of oil came up a lot in 2021, so their revenue has come up a lot. So far in the first 2 months of 2022, oil prices continue to rise, so their revenue might be over $200 billion in 2022. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. The cost to extract the oil from the ground is part of cost of revenue. Also, the cost to refine the oil. Revenue minus cost of revenue gives you your gross profit, and that grew a lot from 19 billion to 52 billion. They're becoming a lot more efficient. Their gross profit is about 20% higher from 2018 to 2021, but their revenue is almost identical. Below that is their operating expenses. Depreciation and depletion are big operating expenses for this company. Gross profit minus operating expenses give you your operating income, and that was the highest ever in 2021 at close to 25 billion. It was negative in 2020 due to lower oil prices and lower revenue. They spent 1.9 billion of interest on their debt, which is lower than 2020 but higher than 2018. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. They have lots of gains in this category. So it could be the gain on an investment in another company, or maybe the gain on the sale of some of their subsidiaries. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which was negative in 2020, but a big positive in 2021. This is the income statement directly from their financial reporting, and this gives us the fourth quarter of 2021, the third quarter of 2021, and the fourth quarter of 2020. Their fourth quarter was amazing, over 60 billion of revenue, compared to 38 billion in the same time period in 2020. They pay about $5 to $5.5 billion a year in excise taxes. These are additional taxes charged to certain items. In addition to oil, tobacco and alcohol get hit with this tax. If you go to your local gas station and get gas for your car, the owner of that business pays excise taxes, so they pass on that expense to you. In the US, excise taxes are pretty low when compared to Europe. That's why it's so expensive to get gas in most of Europe. Some countries in Europe charge $7 or $8 a gallon. If you go to Venezuela, it costs less than a quarter. They spent 36 billion in purchases of inventory. They spent 6.7 billion in operating expenses. All their financials are in US dollars. 323 million of exploration costs because they have to do exploration to identify areas that they can pull oil from. Depreciation, depletion, and impairments, that's 3.9 billion. The big gain in other income and expenses is their earnings from equity interest. If a company owns between 20% and 50% of another company, they usually use equity method accounting. Let's say this company owned 1/3 of an oil and gas company in Brazil. If that oil and gas company reported $300 million of net income in the fourth quarter of 2021, Since they own 1/3, they would report 100 million of equity interest as a gain. But this is a non-cash item, so we have to minus it out on the statement of cash flows. If that Brazilian company paid a dividend, that is a cash item, and they would also have to report those dividend gains. Their net income went up 6x, under 1 billion to almost 6 billion. Here's a breakdown of their revenue from the fourth quarter. 13 billion from integrated gas, renewables, and power. 14 billion from exploration and production. This is the upstream part of the oil process. 33 billion of refining and chemicals. That's a downstream part of the oil production process. And 17 billion from marketing and services. Marketing is the midstream part. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And this number more than doubled from 2020. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. And they always have to spend a lot on CapEx. They spent 12 billion in 2021. Operating cash flow minus CapEx give you your free cash flow. That was their highest ever, over 18 billion. They pay a really good dividend, but another way to reward shareholders is to buy back stock, and they do buy back lots of stock. 4.3 billion in 2018, 2.8 billion, 600 million, and 1.8 billion. Every time a company buys back common stock, it decreases the shares outstanding. It makes your shares more valuable. And you can see they add a lot of debt every year, over 8 billion in 2019, 16 billion in 2020, and 3.2 billion in 2021. And they don't pay down nearly as much debt as they issue. When a company generates lots of free cash flow and adds lots of debt, it's usually to acquire another company. Acquisitions go into investing cash flow. So does CapEx. Their CapEx was 11.8 billion, and they have over 17 billion in investing cash flow. Most of the difference is probably an acquisition. This year, their CapEx will be between 14 and 15 billion dollars. Half of this dollar amount will be for oil maintenance. The other half will be for growth. 3.5 billion for renewables and electricity. Then it looks like another 3.5 billion for liquefied natural gas and regular gas, and a small portion for biomass. Biomass is a material that comes from living things, such as plants and animals. Since living things have energy, biomass provides a renewable source of energy for things like gas for our cars, heat for our homes, and also to make electricity. If the average person won the lottery and made a pie chart for what they're going to do with the money, this little piece here will be the donated to charity part. Ideally for our planet, the biomass part will be a lot larger in future years. This is their operating and investing cash flow section from their statement of cash flows. And the way you calculate operating cash flow, you start with your net income, then you have to add or subtract the non-cash items on the income statement. Depreciation, depletion, amortization, and impairments is one of the bigger items. That was 4.2 billion. That's an expense that brings down your net income. But since it's a non-cash item, we add it back here. We have to minus out earnings from equity interest. In the fourth quarter of 2020, they passed through a loss on equity interest, so we have to add that back. So even though they reported a net profit of 6 billion, they actually generated over 11 billion of cash flow. In their investing section, most of it is investments in property, plant, and equipment. They also disposed of a lot of assets, 349 million, 36 million, and 266 million. So in their investing section, they had a cash outflow of 4 billion. Last quarter was a cash outflow of 2.5 billion. Their revenue is really volatile. It was close to 200 billion in 2015. Now it's about 180 billion. But their revenue pretty much moves with the price of oil. And if the price of oil decreases a lot, like it did in 2020, so will their revenue. But if the price of oil increases, their revenue will also increase. They do a good job managing cash flows. It's pretty consistent year to year. The easiest companies to value are the companies that have consistent numbers. It doesn't matter if they're consistently positive or negative, as long as they're consistent. But when the numbers are really volatile, you never know if the company's going to do well or going to do poorly. I guess oil cannot increase forever, so it looks like it will plateau sometime at the end of 2022 and start to come down. But their operating cash flow projection looks pretty strong and consistent. This is the financing section on the statement of cash flows. They bought back 1.7 billion of common stock in the fourth quarter of 2021. When a company buys back common stock, they put it onto the balance sheet as treasury stock. They paid out 2 billion of dividends. They paid down 3.4 billion of debt. and they paid down $8.4 billion of other liabilities. So it looks like most of the cash flow went to pay down their debt or liabilities. In their financing section, they had a cash outflow of $15 billion. Last year was a cash outflow of $2.2 billion. This is the equity section on their 12/31 balance sheet. They have $112 billion of equity. They combine the funds they receive from common stock and also their retained earnings, which is a sum of all the company's prior net incomes. That totals $118 billion. And they bought back $1.7 billion of common stock. Let's look at the capital structure. $112 billion of equity, $65 billion of debt. They're 63% equity, 37% debt. And their net debt is $31 billion, so they could pay off a lot of the debt with the cash on their balance sheet if they wanted to. Every year, their equity balance is higher than their debt balance. So it looks like they have a pretty solid capital structure, and they also keep a lot of cash on hand. And I gave them a WACC of 9.02%. because it seems like this stock doesn't increase nearly as much as US stocks. I'll show you later when I compare the companies. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $182 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $167 billion. We divide that by 2.6 billion shares. And we get a calculated stock price of $64. They're trading at $50, so they're trading at a 23% discount. It's a buy according to the model. Their revenue is projected to decrease 0.5%, so I lowered their revenue 0.5% each year for the next 4 years. That's how I got their future revenue estimates. They convert 6% of their revenue into free cash flow. The way you figure that out is you just sum up these 4 free cash flow numbers and divide by the sum of these 4 revenue numbers. That's about 6%. So I multiplied their future revenue estimates by 6%. That's how I got their future free cash flows. Simply Wall Street's valuation is $79. That's saying it's 36% undervalued. 3 analysts priced this stock and the average price target is 76. The low is 68, the high is 81. Before COVID, the stock was trading over $60. And then it dropped below $30. That would have been a great time to pick it up. The stock price nearly doubled since the COVID crash. If you bought it down here, your cost basis would be half of what it is today, which means your dividend yield will be double. You would get the same dividend as everyone else, but your cost basis is lower. The best way to gauge their stock price is look at the price of oil. You can see there's a lot of similarities. It was highest in 2018. This crash was actually in April when oil prices became negative. Now oil prices keep going up. So the price of oil is higher than it was in 2018, but the stock price is trading about 15% lower than the price of oil. If history repeats itself, the stock price should go up a little bit to track the price of oil. If you start the S&P 500 and this stock at the same point 5 years ago, they were pretty much tracking each other for about 1.5 years. And the stock price was tracking the S&P 500, but about 20% lower. When both bottomed out, the S&P just took off, while this stock's growth has been pretty stagnant. You have to remember, you get that really big dividend for this stock. The S&P also pays a dividend, but not nearly as much as this stock. If you add the dividend in, then the lines are closer than they are now. The S&P will still be beating the stock, but just not as much as it looks like on this chart. They have a beta of 1.07, so the stock is not too volatile. It tracks the market. It's gone up 8% in the past 52 weeks, while the S&P is up 13%. The 52-week low is 40, the high is 60. The stock is trading between its 50-day and 200-day moving average. 3 to 4 million shares are traded each day on this stock. Of the 2.6 billion shares outstanding, 2.5 billion are on float, 6% are held by institutions, and only 0.25% of the shares are shorted. They pay a 6% dividend yield, and I have a feeling they're going to raise their dividend payment. If they raise their dividend payment, that does not mean their yield would go up. It depends where the stock price moves. If the stock price increases at the same rate the dividend increases, it'll stay at 6%. But if the stock price increases more than the dividend increases, then the yield goes down. And if the stock price decreases more than the dividend increases, then the yield goes up. So they can easily afford this dividend payment. It's only 48% of their net income, 43% of their free cash flow. This is their dividend since 2011. So this line right here is 6%. The dividend is around 6%. In 2020, when the stock price came down a lot, the yield shot up. so it was a little over 7.5%. Now it's at 6%, and the projection is for their yield to stay around that number. They've only done one stock split, a 2-for-1 stock split in 2006. Companies that pay a nice dividend generally don't appreciate nearly as much as companies that don't pay a dividend. So that's why they haven't done a lot of stock splits. If they never paid a dividend, they would do a lot more splits. They employ lots of people, about 100,000 people a year on average the past 5-6 years. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $16,000 today. That's a 5% annual return. 53% of the shares are held by institutions, 43% by the general public, and 4% by employees. That's a way to share the company with the employees. So it gives the employees a vested interest in the company, in addition to their day-to-day job. The higher up you are at the company, the more shares you're going to receive. It's funny they use the word scheme. It comes off as a bit nefarious. The biggest shareholder is Amundi. They own 10% of the company. Amundi is located in France, and they're the largest asset manager in Europe. BlackRock owns 5.3%. The employees of the company own 4%, then Vanguard and Norges Bank. They have really good price multiples, a PE of 8, a price to sales of 0.7. That means their revenue is higher than their market cap, a price to book of 1.2. Let's look at their non-current assets, $32 billion of intangibles, $106 billion of property, plant, and equipment. They have $31 billion of equity investing. These are their investments in other companies. $1.6 billion of other, $2.4 billion of financial assets, $5.4 billion of deferred income taxes. This will help lower the company's taxes in the future, and $3 billion of other. Let's look at their non-current liabilities, $11 billion of deferred income taxes. This will increase their taxes in the future since it's in the liability section. $2.7 billion of employee benefits, $20 billion of provisions. This is money set aside for future losses, and $50 billion of debt. They have a 14% return on invested capital. They can cover their interest payments 13 times. They have a good ROE of 15% and a good current ratio of 1.2. That's current assets over current liabilities. Their quick ratio is a little below 1. Let's look at their current assets. $20 billion of inventory, $22 billion of accounts receivable. This is how much money other companies owe total. $35 billion of other, $12 billion of financial assets. Examples of financial assets are stocks and bonds, and $21 billion of cash. Let's look at their current liabilities. $37 billion of accounts payable. This is how much money total owes other companies. $43 billion of accrued liabilities. These are expenses the company has incurred but hasn't paid it yet. And $15 billion of debt. They generated over $18 billion of free cash flow in 2021, and they have over $16 billion of working capital. Plus, they paid out $8 billion of dividend payments, so they're really well funded. They have $26 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. There are 19 companies in the same industry as Total, and Total ranks third in market cap. Exxon and Chevron are the only two that are bigger. They spend a lot on CapEx. Their debt-to-equity ratio is better than average, but worse than Exxon and Chevron. They pay the highest dividend. They generate lots of free cash flow. And you can see how undervalued the stock is. Look how good their price multiples are compared to average. They're also a lot better than Exxon and Chevron. Non-US companies tend to have limited upside. If this company was in the US, their market cap would be $300 billion. And France isn't a high credit risk. It's not like the company is in China. They generate less revenue than Exxon, but more revenue as a percent of their market cap. That's what the price to sales ratio is, market cap over revenue. Most companies in this industry are not growing, mainly because in 2020 they had low revenue due to low oil prices. To summarize, I have them trading at a 23% discount, and as long as oil prices keep going up, this stock will keep going up and pay that really nice dividend. It seems like owning oil and gas stocks these days is like a money tree. They just keep paying off. I rank their free cash flows 10 out of 10, their revenue 8 out of 10, and their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.